You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, it's Craig Fuhr with Dominion Financial. I'm a loan officer here, and I'm with the co-owner of the company, Jack BeVier. Welcome to Real Investor Radio. We've got a quick hit for you right now, sort of on the recent announcement from Powell and the FOMC. And Jack, for those who didn't tune into the last 5 to 10 minute episode that we did, we'll try to get it out to everyone, but I would encourage everybody to take a listen to that. But you teased sort of what you wanted to talk about on this quick episode in terms of what we might be seeing over the next 12 months from the FOMC and sort of what the other chairmen of central banks around the country are sort of indicating what we could see in terms of rate cuts over the next 12 months. So why don't you jump in there?
Yeah, so everyone's really focused on the Fed having just done a 50 basis point decrease in the overnight rate, which they should be. It's a big move. It was a bigger move than the market expected. What I think is even more interesting is what the Fed is projecting the overnight rate is going to be for the next 12 months. So zoom out a little bit, bear in mind that the overnight rate is what America's banks, regulated banks, can borrow money from the Federal Reserve on an overnight basis. So the idea that a decreasing Fed funds rate, what that does is decrease bank cost of capital.
Sure.
They can borrow more cheaply.
And that's sort of short-term capital, right, Jack? Like short-term loans? Exactly.
And that overnight rate is very, very closely tied to other short-term indices like the secured overnight funding rate, SOFR, which was the replacement for LIBOR. LIBOR used to be used. It got phased out in favor of SOFR. But when the Fed funds rate dropped 50 basis points last week, SOFR dropped 50 basis points last week.
Right.
And so the Fed governors, when they project out what they publish what they think, they each, it's a survey basically of what each of the Fed governors thinks that the Fed funds rate is going to be over the course of the next year. And that's called the dot plot, just because the way that they present the information, there's a bunch of dots on it. And so what that dot plot says right now, everyone's focused on the 50 basis point drop. But what the dot plot says right now is that the terminal rate for this decrease, for this interest rate cycle is about 200 basis points lower than where we are today. An additional 200 basis points of drop in the Fed funds rate over the course of a 12-month period. So that sounds like, if you're a bank, on your face, you're like, oh, great. So it's going to be cheaper for banks to lend. Not so quick, like not so fast.
Signal versus noise, Jack.
Yeah. So on its face, that sounds like, well, that's going to be good. That'll be that'll stimulate the economy because bank loans are going to get cheaper. I'm concerned about that. I don't think that that's necessarily the case because of what else is going on structurally in the banking system right now. So when the banks have a lot of loans, lines of credit to companies and unsecured lines, that
receivable loans, things like that.
Exactly, yeah, that are tied to SOFR. So as the Fed continues to drop the rates, new originations can get cheaper. You would think they might be able to get cheaper. I'm going to challenge that idea in a second. But the existing book, the rates come down. So it's really good for businesses, right? Businesses who have lines of credit, their cost of capital is going to come down because the banks are going to drop. Because as SOFR comes down, the interest cost is going to come down. The interest charges are going to come down on those lines of credit. So it's great for businesses. Not so good for banks though, because they're going to get squeezed, right? Like they were charging us 8%, and now they're going to be charging us. Today they're charging us 7.5%. Next month it'll be 7.25%. And
in 12 months, it could be like 5.5%.
Exactly. The problem, though, if you're a bank, is, and so your margin is going to get squeezed if you're a bank, because what hasn't come down?
Deposits.
And that's a big chunk of bank liabilities. So we've all got it, we all got used to, it took us, as consumers in America and businesses in America, it took us a couple months to figure out that, oh crap, we really need to be moving our cash that was used to be sitting on the sidelines and as non-interest bearing checking account into a money market or short-term CDs, because now we're getting 4.5%, 5.5% on that money. Now banks are going to really want to push that down, because they've got an alternative. One, because they're getting pressure within their book that their loans are, the rates that they're collecting from borrowers are coming down.
Right.
And so they're going to want to and they've got an alternative source of borrowing from the overnight window from the Fed. And so banks are going to want to start pushing down those CD rates, pushing down those savings account rates over the course of the next 12 months. I think we're going to see all of a sudden, we're going to see erosion of the CD rates and of the savings account rates that we're currently getting from the banks, because their margins are getting squeezed, and they can't have loans on their books at 5.5% because the rates because SOFR's come down 200 additional basis points, and they're still paying Sally American 5. That business is not going to work for them. So I think that's a trend that we're going to see over the course of the next 12 months. That I haven't seen anyone yet talking about that, but I can't imagine how the banking system would continue to function if they don't start cramming us American consumers down on the deposit rates.
And so, I guess to tie it all up with a bow, great for the consumer in that they're borrowing now at a significantly less interest, but a lot of strain on an already strained banking system, especially many of the regional banks around the country that do this kind of business.
Well, I think maybe good for some consumers. I'm going to put a little asterisk in that statement. I think you're generally right, but I think it's going to be good for some consumers, those consumers who are working with banks that have a low cost deposit base.
Yeah.
So if you're not getting any, if you're getting very little, if your bank is still only paying 2% on deposits, then those folks aren't going to have this same margin compression pressure, and so
Right.
they may be able to originate at lower spreads. But you may actually see an increase in credit spreads if you're at a bank that has increased a lot of money, increased deposits by paying for them, right? Paying up for those deposits. I think you may see quotes that stay at the higher rates for longer, because consumers just don't accept it right away, right? You drop deposit rates. It's so easy now to move your money between banks.
Yeah.
You can you go to a website like Raisin, and you can see 30 different bids for your deposit rates, and so you just sort by whoever's paying you the most. It's insured by the federal government wherever it is, and move your money from one bank to the other. So banks are going to want to push deposit rates down, but as soon as they start doing that, the first mover is going to see flight to other banks. And so the regulators are still the banks are still under super watchful eye of the regulators. So the first bank that tries to decrease deposit rates in order to maintain margin is going to have a flight of deposits to other banks, and then that bank will have the FDIC up their ass because their loan to deposit ratio is all of a sudden out of whack. So it's going to be a tough balancing act for banks to pull off over the course of the next 12 months. But since the Fed is telling us that they are going to drop rates almost as fast as they raised them, that is going to lead to some mess, right? Like, you can't move interest rates that quickly and not have some unintended consequences. And I think that's the category, that's the area that we should be paying attention to in this rate decrease cycle. And I would expect there to be some shakeup as a result of that.
Jack, I pulled up a great quote from Thomas Jefferson, the prescient quote from 1816, where he was talking about the role of central banks. And he said, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property. I think that's a very interesting quote during this time, Jack.
And a lovely closing quote for this segment.
Yes. All right, that's a quick one from Real Investor Radio. I'm Craig Fuhr with Jack BeVier. Thanks for tuning in.